economy should stay very healthy. China may not be growing at that 10, 12% growth rate, but I'm confident they'll still grow at 4, 5, 6% a year.
Okay, Tony, if investors are looking to get into Asia, where would you recommend they put their money?
Sure. First of all, you need to look at non-dollar denominated assets. Specifically, I'm talking about foreign bonds and foreign stocks. Or, as Larry mentioned, you could own hard assets such as gold, oil, natural gas, coal, uranium, even water and food. Also, if you're looking for a good, safe-term, short-term place to park your money, take a look at the Merck Hard Currency Mutual Fund. Its biggest holding is the Spider Gold Shares ETF, but it also holds short-term commercial paper from countries like New Zealand and Canada. It does have mild currency risk, but really very, very little. And in terms of hard assets, I really like an agricultural play called Bunge. It's the world's largest supplier of soybeans. I recommended it in my latest Asia Stock Alert.
Okay, Tony, as we see this next recession coming toward us, what can we learn from what Japan went through and I guess in some ways what they're still going through?
You know, I believe Japan's problems can serve as a real cautionary tale for the U.S. Take a look at the Japan benchmark index, the Nikkei 225. It hit its peak around the same time the U.S. market crashed in 1987. Now, more than 2 decades later, it's still only 70% below where it used to be. So Japanese investors have less than a third of their money than they did in 1989. That's a generational wealth killer, and that's what we have to avoid here in the U.S.
Tony, why do you think something similar is going to happen here?
Oh gosh, because we're trying to attack the problem in the same way that Japan did. Japan let its sick banks carry all their bad debt on their books at par and disguised all their problems. They didn't take their medicine, and they stayed sick for decades because of it. In the U.S., we just shifted all our bad debt from the private sector to the public. And number two, Japan thought it could spend its way back to prosperity. Sounds pretty familiar, doesn't it? We're saddling ourselves with so much debt that is going to be a millstone around our necks for generations.
Okay, what's the solution then?
You know, it's really simple, but it's a difficult one. We have to cut back on spending. It's going to be painful medicine. It may cause failure of more banks and other businesses. So unemployment probably will go up in the short term. But failing companies should be allowed to fail, because as we're finding out now, the alternative is even worse. And as Japan showed us, if you paper over the problems with more bailouts and stimulus spending, it may not be a few years of pain, but decades.
Okay, Tony Sagami out of Bangkok. Thank you, Tony.
Thanks, Jamie.
Well, it is a drastic solution, but is it necessary? And perhaps more importantly, do our leaders have the political will to actually implement it? Washington and governments around the world must struggle with those questions, but for you, the question is simpler. How can I protect myself? This week on Money and Markets, we've given you several ways to do just that. And coming up next week, we're going to give you one more, gold. I'm Jamie Holmes, and now, Mike Larson.
Thank you, Jamie. Folks, I wish I could tell you that a double-dip recession is avoidable, that we can spend our way out of it, or maybe stop it in its tracks by going in the other direction and cutting to the bone. But I can't. Another deep economic downturn is coming. It may even be here already. Our job here is not to spread doom and gloom about that, though. It's to offer solutions. And that's where I have some good news. There's still money to be made in a down market. We've told you how to hedge your downside risk by using treasuries and money market funds or dividend stocks. And we've told you how you can profit from declining markets by investing in inverse ETFs or maybe holding hard assets. We've also shown you how other countries can illuminate our own problems and give you new advice on investing overseas. But I also have some advice for our own government. Don't try to stop the next recession. As Tony Sagami said, it needs to happen. We need to go through a period of deleveraging and start from scratch. Sure, it may be really bad for a few years. Unemployment's going to go up, banks will fail, the stock market may even tumble. But that will allow us to build from the ground up with a leaner, meaner, healthier economy. I like to think of what happens on Bourbon Street when Fat Tuesday turns to Ash Wednesday. You see the police on horseback roll down the street, and it gives you a clean sweep, a clean slate to start over. You know, Washington will have you believe that this type of cleansing should be avoided at all costs. But look where their proposals have gotten us. Arguably, we're worse off now than we were before the bailouts and the stimulus. I believe Americans can handle hardship. And if we go through that short-term pain now, we won't be burying our grandchildren under mountains of debt. And moreover, we'll lay the groundwork for a real, healthy, sustainable recovery. I'm Mike Larson. We'll see you next week on Money and Markets.